You've probably drawn hundreds of trend lines, but chances are you're using them completely wrong, and it's quietly killing your trades. In this video, I will cover what trend lines are, how to draw them accurately, and how to implement a strategy using them. And then I'll show you real-life, live examples. By the end of this video, you will know what trend lines actually are and why they're the foundation of all technical analysis. Let's begin by understanding what a trend line is. Trend lines are the OG technical analysis. All charting concepts originate from trend lines, and without them, we might be better off throwing darts at a board. Trend lines are the visual indication of a market's direction and speed, so understanding them is critical to understanding trading. There are two basic types of trend lines. A bullish trend line is drawn by connecting higher lows. When done correctly, it will create an upward sloping line. The other type is a bearish trend line, and you will find these when you connect lower highs, creating a downward diagonal line. Trend lines act as a dynamic support and resistance. They help highlight areas where price may react, zones you might overlook without the trend line in place. They can also help us identify potential changes in trend. When price breaks through a trend line, it may signal a shift from a bullish market to a bearish one, or vice versa. So how do we draw trend lines that work? To start using them, we will first need to have a charting program like TradingView.com. The next step is selecting an asset in a time frame. The asset can be anything you want to trade: stocks, crypto, or even gold and silver. It's totally up to you. Trend lines work the same in every market. The most common next question is, what time frame should I use? I have a full video explaining how to use time frames on my free trading playlist at youtube.com/TomCrown. That video goes even further in depth on this topic. But for trend lines specifically, it's important to first zoom out to the largest time frame available. Anytime you start a new chart to begin analysis or look for a trade, you must examine the overall trend of the asset. This means zooming out and identifying an upward or a downward bias. Typically, starting on the monthly time frame is large enough, and we begin by marking out our major trend. To do this, go to Tools and select Ray. Weirdly, don't select Trend Line. A ray is a trend line that extends past our selected points. Don't ask me why TradingView is making it so complicated. To make it extra easy, my pro tip: enable the magnet on the toolbar as well. This will make your trend line placement perfect by snapping both points exactly to your candles. Typically, the major trend can be found by marking the lowest 2 points on the chart together, and then the 2 highest points. If both these trend lines are sloping up, this market has an upward bias. But if both are sloping down, the market has a downward bias. Once we've done this, we can begin to zoom in, moving down to the weekly time frame. You'll notice our trend lines are no longer connected to our candles. We will adjust these to make them more accurate by re-snapping the points to the candle wicks. We will repeat this process every time we move down to a lower time frame. As we move down in the time frames, new trends will start to appear. These represent smaller and smaller time frame trends. It's important to note that while they are all valid and potentially tradable, the lower the time frame becomes, the weaker the trend it represents. So to answer the question, what time frame should I use to trade trend lines? The answer is all of them. Over time, you'll develop a preference, but for now, just use the biggest time frames you can until you totally master this concept. Now let's talk about the important stuff: implementing trend lines into your strategy. Everything we've talked about so far is basic and surface level. Utilizing trend lines in your trades is going to take a little more nuance. In general, when price moves towards a trend and tests them by attempting to break through them, There are only two outcomes we have to look for. The trend line either rejects price and reverses, or it breaks through and pushes past. This is known as a breakout. In the normal scenario where trend line rejects price, it creates a very easy trade setup. If price is moving upward toward a trend line, we can look for it to act as resistance. This allows us to confidently bet on price moving downward from that level. We can do this by opening a short position, allowing us to profit when price reverses. If price is instead trending downward and approaches a trend line below, we can bet on price reversing course and moving up. By placing a long position at the trend line, we can look to capitalize on this trend holding as support and pushing price back higher. In a perfect world, all trend lines would hold, acting as support or resistance when price tests them. But in the trading world, it's not that easy. There are times when price breaks out, pushing through the trend lines and catching traders off guard on the wrong side of the trade. To make matters worse, it can often be difficult to tell in real time which scenario is playing out. Price can move to trend lines and appear to break them right before reversing. And this is what we call a fake break. And being able to identify these consistently is a gold mine in trading. Price may briefly push above or below a trend line, giving the illusion of a breakout before reversing sharply. These moves often lack momentum and are made up of small, weak candles. This is how breakout traders get trapped. When you see this type of price action, patience is key. Let the market prove itself before committing to a position. A real trend breakout is usually supported by strong momentum, large candles that decisively break through the trend and continue in that direction. To be extra cautious, you can wait for a break in market structure, such as price forming a new higher high or a new lower low. Once structure aligns with the breakout, entries can be taken on pullbacks into newly formed levels. Here's a few extra tips for drawing trend lines the right way that will help you avoid getting tricked by the market. Number 1. Use the wicks of candles to draw trend lines. Some traders use the candle bodies, but I find that to be a less successful practice that's got me caught in some very bad trades. Number 2. Look for trend lines at obvious swings in price, areas where price has strongly reversed and moved away from. And my third pro tip, while any 2 points can make a valid trend line, it's easy to overfit. Avoid placing trends to justify the position you're looking to take. Bias in trading is a profit killer. We can talk about trend lines theoretically all day, but let's put these ideas together and show how traders are using trend lines to take real live trades. On this chart, we can see a clear uptrend marked by higher highs and higher lows. By connecting the lows, we can draw a trend line that price has respected 3 times, making it a valid level. Eventually, strong selling pressure enters the market, causing price to break below the trend line. Momentum begins to shift and a new lower low forms. This looks like a true trend line breakout. A short entry could be considered on the retest of the broken trend line and the previous horizontal support, which has now flipped into resistance. A stop loss could be placed above a recent high looking to the left, and a take profit targeting a lower level of price. Let's look at it a different way. This market is clearly in a downtrend, and we can look to identify 2 obvious swing points to anchor our trend line. As price develops, it rallies and briefly trades above the trend. However, looking closely, this move lacks momentum. Price fails to hold above the level and eventually drops back down, suggesting a fake breakout. After that, price sweeps the range lows and pushes higher with strong bullish momentum. Notice how this move is much more aggressive and covers a larger range compared to the earlier breakout attempt. Based on this, a long entry could be taken on the retest of the swing high. with the stop placed below and targets set higher above. If this video finally made Trendlines click for you, then do me a favor, click the like, subscribe, and turn on notifications so you never miss the next free trading tutorial. Drop in the comments right now what your biggest struggle is with Trendlines, fakeouts, drawing them, or is it even something else? I read every comment and I will reply to as many as I can.